So hello and welcome to the first video of the channel, I guess, but the first pre-market news briefing for the markets, obviously. So to just set out how we're going to go ahead with this is essentially I'm going to start off with the headlines, go through any major headlines for the day. You'll be able to see those major headlines just below me on the rolling text, and so those should state the main headlines which might affect the markets. A lot of these will be macroeconomic related, politics related, but anything that's really going to be pushing the markets one way or another for the date 24th of August. So that's essentially what we're here to do. We're then going to have a look at the charts for a brief moment, depending on what sort of news there is and how it's going to affect the charts. But we'll see the main key areas and that sort of thing. But yeah, that's essentially it. We can get right into the first headline, I guess. So yeah, the euro drops below the 2022 low mark to mark the last seen 2 decades ago. Now, obviously, we know that the euro's recently dropped below parity, so now it's weaker than the dollar, and that's essentially what we've seen yesterday or today when I'm recording. But essentially, the euro's dropped below that $1 mark, and now it's trading below at around 0.99 cents. But this is down to a multitude of reasons, really. A lot of people have put it down to, a lot of economists have put it down to the fact that obviously they're waging Russia-Ukraine war, which has been damaging the euro currency as energy prices have really been skyrocketing. As a result, consumers can buy less, and as a result, the currency drops. Also, this is also coming off the back that at the moment we're having other challenges in Europe to do with the drought, with really high temperatures within mainland Europe, and this is damaging just overall productivity and thus creating more shortages on top of the shortages being created by the Russia-Ukraine war and the energy prices along with that. So those are the three main reasons for the euro dropping low, but it's also largely because of how strong the dollar's been recently. Obviously, the dollar's been seeing a lot of strength coming off the back of these rate hiking increases that we've seen lately from the Fed, and it's sort of having an effect on inflation, not as much as I'm sure the economists would hope at the Fed, but it's certainly having an effect. And this is, what investors are looking for when they're trying to move their money away from risk assets. When we're moving towards a possible recession, they want it in a nice safe area, and that's the US Treasury. So they're storing their money in a dollar, and they're making the best interest of that as they can. So the dollar's skyrocketing, the euro's falling, and as a result, we're seeing very, almost uncharted lows for the euro dollar in recent days. But we can move on to the next headline now. So yeah, the next headline really is same, coming off the back of energy crisis and inflation, everything against the dollar. We're talking about pound dollar now, cable. Now, JP Morgan is actually warning the idea that the pound dollar will actually fall to the level of 1.14 cents to the dollar. I've probably said that wrong, sorry. $1.14. Now, at the moment, I believe it's trading around 1.18. We can check that real quick. Sorry. Oops. So yeah, we've got the pound dollar trading around 1.18. 1.18. And so analysts at JP Morgan forecasting that it will drop below this heavy low of found dropped below this low found in the COVID lockdowns, the very start of the COVID lockdowns in 2020, of 1.141, and actually reached that 1.14 mark. So this is not looking good for the pound. Anyone living in England, and yeah, it's really not looking good. So if we're looking for shorts on pound, that's what institutional market sentiment's looking at the moment. They're looking at prices, GBPUSD falling to that level. So that's a good key idea to have in our minds coming into these situations. I'll bring you back onto these charts. Sorry, I've kind of messed this up, but it's the first video. What can you do? Sorry about that. So yeah, we can move on to the next topic. UK economic demand hit as weak demand and labour shortages bite. And this is also the Wall Street Journal's main headline today, with global economies flash warning of sharp slowdown. And essentially what we've seen today and a few days before, I'll bring this up on the good old economic calendar. We've got Germany, and we've got the United Kingdom, and essentially not so much for Germany, but for the UK economy, we've seen actually a decrease in private sector business, with a decrease in manufacturing output, and so this is not looking good for the economy of the UK, but it can largely be explained by the current macroeconomic conditions of the UK. We have, skyrocketing energy prices, making it harder for businesses to produce goods. We also have the Russia-Ukraine war limiting supply, and so they aren't able to get the goods that they need to produce. And it really makes sense, along with the rising interest rates, which are ultimately restricting investment and anything business-wise. So we're definitely seeing a few troubling signs coming from the UK economy, and also the global economy, as the Wall Street Journal says, with the US economy and the Eurozone also seeing these sort of, economy indicators hinting for stagflation. Whether you say we're in a stagflation period or not at the moment, that's what we're looking like we're heading towards, if nothing else. And so the next topic, this one focused on the Twitter stock, obviously, with Twitter having a whistleblower from the head security team, I believe. Yeah, a former Twitter security chief. He's become a whistleblower and left Twitter, I think back in January of last year. I can find this here, sorry. Not quite sure when he left. I must have read it on another article. But anyway, he has left the company, and now he's essentially talking about how Twitter has covered up their bots, the number of their bots, and essentially everything that Elon Musk ended up using as an excuse to back out of that 44 billion deal on buying Twitter. And obviously Twitter are a bit upset about that, and they're chasing him down for that. But I think Elon Musk is taking on okay, I'm not going to try and pronounce it, but Satok, I'm just going to say that, and trying to get statements from him as this legal issue is being solved between Elon Musk and Twitter. Here we have Musk's legal team issued a subpoena to Dorsey, who stepped down as Twitter's chief executive. He was another person who sort of made a mockery of Twitter recently. So obviously there's lots of Twitter problems, and all these Twitter problems have culminated into a 5% fall in price just yesterday. I'll bring that up now. So yeah, this is the fall that we've seen. I'll bring it onto the daily. So essentially, markets fell from that 41.3 area, and left markets at a pretty poor area since market close. So 7% decrease in price, not looking good for Twitter if you're holding onto that stock, but that's the way it goes with these legal issues. So yeah, we can move on to the next topic, that being US home data. So US home sales has tumbled to 6.5 year low, but despite this, really, we're not really heading towards a housing market failure, analysts are saying, because essentially we're still holding that high price level. Now if I can find it down here, we've actually seen an increase in housing prices over the last year, with an increase in prices of, sorry, can't seem to find it. However, essentially, sales has tumbled 12.6% since last month, so the lowest level since January of 2016. This isn't looking good for the housing market, but as I said, median house price is still up 8.2% from a year ago. So although we're seeing this decrease in the sale of houses, we're actually seeing higher prices. Now, this phenomenon can easily be explained essentially by the situation we're experiencing with high interest rates. This is driving mortgage rates a lot higher, and thus it's harder to take a mortgage. These homes with previous owners, they have inflated prices on the back of all other economic conditions at the moment, and so frankly there's a lack of houses being sold, and the houses that are being sold, it's very hard to get mortgages for which are affordable for people. So this is what we're going to be seeing over the next year, even with interest rates staying quite high to try and tame inflation. But it's said by many analysts at the moment that this is really what the Fed was looking for when it was raising rates. They needed to cool off the housing market. The housing market was frankly too hot, and hopefully this will cool the market even more. So hopefully in the future, some people will be able to get on the housing market, but we'll see. So just bring us back to all the data that we were talking about. So the inflation rate for the UK is currently at 10.1%. So it's not hard to see why pound dollar is being expected to fall to that 1.14 rate. Same for the Eurozone. We're reaching nearly 9% in inflation rate. It's understandable why we're seeing such lows. You might be asking, well, we're seeing that with the dollar as well. Yeah, but the dollar's a bigger currency, and so when they're raising rates, it's a lot safer for people to put their money, and so they're receiving large returns on a pretty safe investment in comparison to these European countries that are really near to the Russia-Ukraine crisis and really being damaged by the energy crisis within Europe, and thus ultimately they're more affected, and ultimately their interest rate hikes are less effective, as we've seen with the UK coming out with way higher inflation figures than forecast, and same with the euro. So that's essentially explaining the current phenomenon between the euro dollar and the pound dollar. So yeah, but we can bring this on to the economic calendar now. So obviously on the 23rd we had the main PMI flash readings, and now today or tomorrow, we're going to have the durable goods orders, so we can see how that will affect the industries in the US as well. So I guess we'll have a look at these graphs. So yeah, this was essentially what I was explaining to do with the euro dollar parity. Obviously euro has dropped to its weakest levels in decades, and here's with the pound. This is where JP Morgan's expecting the pound to fall to. And so we'll just take a final look at the charts before I leave. So yeah, we can start off with US 30. So obviously US 30 had that strong run off the back of that large rally to the downside. Dip to the downside since rates started being raised and called for being raised in December 21. And so now we're seeing that rally push back up as the Fed has moved to a more dovish position. Obviously, that's not so much the case anymore, with a more hawkish stance being proposed. And so we're seeing this fall to the downside again, especially off the back of those PMI readings. And so same for the US 100, the NASDAQ, also seeing that dip. And so if we're looking for buys, if that's what you're looking for, I would really be looking around these sorts of areas here. You know, strong supply and demand here. We've obviously had wicks to the downside. Obviously, a lot of buys coming in here and a lot of sells coming in here. So we know that obviously lots of people are using this for their areas. If you are looking to buy, this is where I'm probably going to be looking. Let's put on a fib here. Remember guys, it's not financial advice. So yeah, we're at that 50% fib right now. So I wouldn't be surprised if we move off that, and same for the 61 coming at the bottom of that supply and demand zone. So it'd be really interesting to see how the NASDAQ responds to these levels. And if it moves lower, then, you know, it's not looking good for the NASDAQ, but we'll see. It all depends on the macroeconomic position, remember. And now on the S&P 500, we're seeing that same move to the downside. But what interests me about all three of these main US indices is we've all broken this market structure here. So we had, you know, higher high, and then we started dipping. We had a lower low, lower low, lower high, lower low, lower high, lower low, lower high, lower low, and then we broke that structure here. So we broke that level of 33492 on the US 30. We broke higher, but now we're having that retracement, which was expected. And so it's really just looking for those buy areas. And once again, buy areas look good around the level that we're at the moment, but we'll have to see. Obviously, there's a lot of supply and demand around these sort of areas because price interacted with it a lot before. So that's my opinions on the main US markets. Obviously, UK 100 ranging around, and the Dixie. So yeah, this is what we're talking about with the dollar and its strength. It's just immeasurable strength, still pushing higher somehow, and reaching those 109.21 levels on the 23rd. So just immeasurable success for the dollar recently, and the pound dollar obviously reaching those new lows since March 2020, right? So it's really crazy what we're seeing to do with the dollar and the pound at the moment. Really hard to trade, I would say, just along with all this volatility, and especially with the UK seeing such volatility around having a new prime minister, and you know the uncertainty around that. And so if I was looking for shorts coming off the back of those headlines to do with JP Morgan, I'd definitely be looking around that 12078 area, just due to that large accumulation period here, and then accumulation period here, and that sort of thing. But pound dollar isn't really my thing, and it's sort of the same story for the euro dollar. Obviously, we're making those new lows, and yeah, lots of accumulation above. So it's hard to know really where to get in at these levels. Pound yen, once again, still ranging around. In comparison to this kind of clean price action throughout 2021, and this what really interests me about pound yen. You know, we really changed from that very easy to trade price action to now this very harsh, large wicks volatility in the pound yen at the moment. So I'm really waiting it out, maybe looking on the lower time frames a bit, trying to find some levels. But obviously we're in a downtrend kind of range sort of thing here with that. So it's really just trying to find these levels and trade them using a lot of fibs and that sort of thing. Now Bitcoin, Bitcoin had its sort of run from its low at 1785, and that pushed its way up through a sort of upward rally, almost with a counter trend line under here, and now it's kind of testing that trend line almost. Sorry, I need to draw that a bit better, but yeah, it's sort of testing that trend line, but also it's sort of broken this trend line. So the trends on Bitcoin are really interesting at the moment, and it's quite hard to tell where it's going to be going. Obviously, we need to be looking at Bitcoin in the sense that it is a risk asset. We need to be looking at it from a macroeconomic point of view, despite it being a crypto, because obviously coming off the back of those rate hikes, Bitcoin was ultimately damaged, and so we have to factor that into any analysis to do with Bitcoin. So keeping an eye on the Fed will be perfect for being able to time an upward move on the Bitcoin cycle, or even a down move if inflation doesn't lower and they just have to keep on raising rates. And so we're at this high level of supply and demand at the moment, with this low obviously showing, and then all these wicks that pushing into that area of supply and demand. Here. We've all had accumulation in this area, and so if we're looking for buys to the upside, I wouldn't be surprised if this was the area that people were getting in. But yeah, Ethereum, much the same story, and gold, really interesting asset at the moment. Obviously, coming off the back of the Russia-Ukraine initial invasion, and the initial spike. We'll have a look at that now. The initial spike in price, reaching such high levels of $26.9 dollars per ounce, I believe. So yeah, really crazy prices, really. But looking on a lower time frame, this is what I've been trading the most, and looking at the most, I mean, if we're looking for buys to the upside, really should be drawing some fibs intraday, kind of looking at this. But this is some analysis I picked up earlier, just 78.6 fib, and that kind of area of supply of accumulation. I mean, just down here, it would be really interesting to see how price reacts to this sort of area if we're breaking structure, because we've sort of broken structure here, but it's hard to really know if there was structure there anywhere in the first place. So it's really keeping our eye on the markets, but we're quite dry on any macroeconomic information tomorrow / today, but on Thursday and Friday we get a bit more information, because we get our price index report and also Powell speaking, so that'll be really important to see how markets are going to move. But that's essentially it for today, guys. Thank you so much for watching. This is the first video. I know it was a bit poor and a bit all over the place, but I'm really just trying to learn it and produce the best quality videos for you guys. So if you do have any information or anything, make sure you're following our socials just down there. Wildwood Capital on Instagram and Capital Wildwood on Twitter. We're going to start becoming more active on there and producing a lot of content. So subscribe, turn on notifications, follow our socials, and yeah, that's all for today, guys. Thank you very much. Bye.